Hello everyone, I'm Mike Dubé from CaseNet Media.
And I'm Brianna Hike from Acadia University.
And today we're going to be talking about if you're off to a great start. Well, actually we're talking about venture capital. But it had to do with having a great start. Do you have anything?
So you've got a great business plan, you've proven it can work up to this point in time, but you are missing one important ingredient, and that is capital. Venture capital can be the perfect tool for specific entrepreneurs in a certain specific case.
So just to dive a little deeper into that, what is venture capital? Well, venture capital is equity that goes into growing projects or startups that appear to have potential for high growth.
It essentially allows businesses to be able to grow bigger and stronger. With that being said, though, it does have a few unique facts, so to speak.
Exactly, and Scott Maxwell had a couple of unique perspectives to share about the industry, and he's been a venture capitalist for about 11 years now. And some of the things that he mentioned were some of the little quirks that they were only interested in getting a few new customers per year.
They also wanted to grow other people's businesses faster than their own.
And strangely enough, they want their customers to be bought out by larger companies. But despite all these quirks, if you investigate a little further, venture capital isn't all that charming as it's made out to be.
So in the first quarter of 2016, venture capital deals were, so to speak, approximately 838 million. And even in terms of the historical rankings, that was a huge year for them.
Yeah, and even more shocking was the Harvard Business Review actually stated that only fewer than 1% of US companies historically have been raised from venture capital. Fewer than 1%.
So, in fact, non-venture capital financing areas are actually growing as well. So in 2011 alone, angel investors actually were able to fund approximately 6 more times the amount as original funding techniques that were being used by venture capital.
So here's some numbers. Angel investors invested in 65,000 companies, where venture capitalists only invested in 3,700 companies. So another thing to consider is venture capitalist groups always take calculated risk with what they're investing in, of course, yet an estimated 60% of even just the good funds will lose money or just break even. Venturecapital.com put it blatantly, and they said the losses come early, and the winners take time to compound. So sometimes you have to wait out the years of carnage before being out in the wilderness, hoping that the hits come through.
So now you've got all this capital, now what?
Well, Paul Graham, a notable investor, commented that venture capitalists don't invest millions because that's the amount you need. They invest that amount because that's the structure of their business, that it requires them to invest. So this is a stretch, but he said, like steroids, these sudden huge investments can do actually more harm than good. And he noted that an example was Google. They were an exception because they survived venture capital funding because they could legitimately absorb these large amounts of money that were being pumped into the company. But less fortunate startups just end up hiring armies of people to sit around and have meetings, sort of like us.
So this, however, wasn't the case for Blaire Ryan. And Blaire Ryan is the co-founder and CEO of The Rounds. And in fact, it was quite the opposite. So The Rounds is essentially a company that allows for physicians to get in contact with each other and therefore provide the best possible sources of information as well as contacts for one another.
Yeah, Blaire actually had a really interesting story about his company. They successfully raised over $1 million on a 12-month plan to aid a startup after approaching investors.
Okay, however, with that said, the company actually ended up hitting their goals about a few months earlier than they expected, and that was at the 5-month benchmark. Yeah,
so Blaire's issue now was, can they sustain the momentum of their current plan that they had originally had at that point in time, or what do they do with their 12-month investment, essentially?
So they could have waited for that period to end, I guess, but at the same time, what was the opportunity cost of doing so?
Exactly, and some venture capital models have been declared as dated and flawed, and business owners are frustrated with all the pitfalls that are associated with introducing them. And some of these pitfalls are things like forced management changes, loss of equity stake, decision-making abilities, and delays in funding or even high fees.
And with that also being said, we need to take into consideration what we were speaking about earlier and how there's all these now other forms of financing, such as the angel investors, as we mentioned earlier.
So I guess the moral of the story here is be careful what you wish for. But we're fortunate enough to be in an age where there's so many other financing options available for all entrepreneurs. So let us know what you think about the venture capital model, and to find out more about what Blaire Ryan from The Rounds actually ended up doing to discover his solution, be sure to check out the link in the description to our CaseNet website, and that's all for this episode. Thanks for watching.